The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
NASDAQ's tenuous recovery loses momentum as the investor rotation out of tech accelerates. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld.
Hello.
We're kicking you off to the closing bell here in the U.S. And boy, an ugly week. It's getting even worse. The S&P 500 down by about 0.9%. As Romaine mentioned, it's that tech rotation that's really taking the market down with it. You can see the NASDAQ 100 lower by 1.5%. Meanwhile, the bond market, no haven today, pretty much flat when it comes to that 10-year Treasury yield, hanging out just at about 4.15. And the Magnificent Seven as a group down by 1.6%, Romaine.
Yeah, one of those days where the price action is driven much more by deteriorating chart patterns and souring investor sentiment rather than fundamentals. The S&P threatening to close below that 50-day moving average. Remember, the NASDAQ 100 ended last week below that technical line in the sand, and today is testing its 100-day moving average as investors rotate out of tech and increase exposure to energy, to consumer staples, and to healthcare stocks. Now, this is not the macro story about yesterday's jobs report or even tomorrow's inflation print. The technical breakdown today links directly to the fundamental scrutiny of the heavy spending on AI and whether that spending is still justified, particularly amid troubling signs for data center giant Oracle and the feasibility of its off-balance sheet financing for that massive 250-acre project in southeastern Michigan.
The other big risk, of course, is going to be around AI, and we have seen that narrative shift where there's more and more questions. So I'd expect that every earnings season will be looking for proof of delivery. Really, are these companies delivering on these expectation earnings? And can they continue to reassure concerns from investors that there is a bubble building up?
And well, the last chance at proof of delivery, at least for this earnings cycle, comes tonight. Micron, the typically staid maker of memory chips, reports after the bell, but don't get your hopes up. The stock is sold off the day after each of the last 4 earnings reports, despite beating estimates each time. And with the stock already the 6th best performer in the S&P this year, having almost tripled, it's hard to see how much upside is left, Katie.
Well, that's the micro. Let's go back to the macro. As Romaine mentioned, we do get CPI figures tomorrow. Here are the expectations. This is data for November. You can see that headline expected to come in year-over-year basis at 3.1%. That is slightly above what we saw in September. Meanwhile, you take a look at core on an annualized basis. The expectation is that it's going to stay flat at about 3%. But those are just that. Expectations. We know, of course, that reality could be much different, and it's unclear, Romaine, what the reaction function of this market is. We got that jobs print yesterday. Good news on the jobs front didn't necessarily translate into good news for the stock market. So it's going to be important and informative to see how the market takes these numbers tomorrow morning. Yeah, 2 interesting bookends to this week. Let's bring in Andrew Szczurowski, Strategic Income Portfolio Manager at Morgan Stanley Investment Management. And we talk about those bookends, that delayed job report yesterday and the delayed CPI report that we get tomorrow, Andrew. Which one do you think is going to guide investor sentiment more?
Look, I think in the short term, obviously, the CPI report market's going to be focused on that. I think over the long term, what the market, what the bond market, what risk markets are going to be focused on is actually the labor market. Obviously, we know there's this kind of the dueling Fed mandate here. And I think that over the short term, inflation's a problem. But I think if we fast forward a year from now, I don't think inflation is going to be a problem for markets. We still have this kind of pig moving through the python, which is that kind of tariff inflation. But I think over the next 6 to 12 months, that's not going to be much of an issue. And the Fed's going to be clearly solely focused on the labor market.
Where do you see actual economic growth, at least here in the United States, going next year? Because it's one thing to talk about the labor market in and of itself, and for that matter, inflation. But at the end of the day, this is also a story about economic growth and how much we can actually anticipate into 2026.
Yeah, I think we might be entering a little bit of a unique era where we see reasonable growth here. So 2% or so GDP growth, but it doesn't translate on the labor side of the equation. If you look at what some of the big drivers, you're just talking about obviously that AI spending and all that CapEx that's going in there. That's been a big contribution to GDP, but it actually hasn't been that big of a contribution on the labor side of the equation. I think that's one of my fears going into 26 is that we actually get kind of reasonable growth, but no labor growth. And then what does that look like if all of a sudden wages aren't rising? Because as we've seen, if over the last 6 months, we've actually had only 16,000 job gains, and that's not keeping up with actually labor force participation growth, even if it's a bit lower. And so I think that's going to be a challenging environment for the labor market, and that's going to be something the Fed's going to be looking to actually push against with further rate cuts more than the market's pricing in 26.
Well, Andrew, what does that look like in the markets if that situation does play out, where we do get economic growth, but not necessarily with labor growth? How do you structure a portfolio around that possibility?
Yeah, I mean, look, it's not the worst thing for risk assets. It may be a bad thing for the labor market and for employees, but part of this is a little bit of a productivity boom here. And so obviously these companies are spending money on AI, data centers, all these things. Part of that is to replace labor to some degree. And so as far as investors go, that's not the worst thing. On the bond side of the equation, look, we think that, some of those deals, those AI data center deals, they've come out, we haven't invested in them because you just don't get the upside like you do on the equity side of things. So on the bond side, obviously we're bond investors, we're trying to get back par on our investments. And if you're getting these deals coming at 200 or 225, it doesn't make as much sense. You don't have that free option upside like you do on an equity side.
Right.
But there's still plenty of other places to find value in the bond market. One, I think that, just sticking in high quality agency mortgages at a time when housing's unaffordable. It's unaffordable because mortgage rates are high. And spreads are still at the kind of wider end of the last decade there. So you don't have to be cute with these markets. You can kind of just hide out in the high quality space for now and then wait for these opportunities to develop out the credit risk spectrum.
You don't have to be cute in these markets. I also really like this line in your notes that people should keep it simple right now on the bond side, that many parts of the credit market aren't paying you enough to take credit risk. Andrew, where in bond land is that especially true?
Yeah, look, if you look at where kind of IG corporates are in the kind of first decile, right now, credit risk, you're being compensated for that kind of yield in credit markets, but that's because base treasury yields are high. And so it's not coming through the spread side of the equation. Now, it doesn't mean that's going to change in 2026. This could be basically a period like 2004 to 2006 where credit spreads just stay tight for the next couple of years. Like that's a very reasonable scenario that could play out. We do think there's still places to add value in the U.S. and commercial mortgage-backed securities, commercial real estate, a sector that's been beaten up. That's my favorite space in the credit market. But again, there's for active investors, these opportunities now are kind of fewer and far between. But that's basically what we get paid to do, is try to source those kind of alpha generating ideas across the landscape, but they're just getting fewer and more far between.
I am curious, though, about just this idea of the credit markets overall and the general health, and the idea that maybe there is, at least on a relative basis, a little bit more risk-adjusted safety in something like mortgage-backed securities and other sort of asset-backed securities. What is the argument for that, Andrew?
I mean, look, right now, the reason why agency MBS spreads are wide, there's a couple reasons. And it's partly that if you look at what's going on in the Fed's balance sheet, we have quantitative easing on the Treasury side, but we actually still have quantitative tightening on the mortgage side of the balance sheet. So the Fed's still shrinking their mortgage portfolio. They're the second biggest holder of agency mortgage-backed securities. So you have this negative technical that's actually been a positive for investors because it's just kept spreads wide. So that's one thing that's keeping those markets wide. And then on the other side of the equation, in credit markets, you've just seen tremendous flows into bond funds, into core bond funds, I run a multi-sector bond fund that's had great inflows this year. And the reason we're seeing that, one is that on the core bond side, it's that people see these yields at the start of the year were 5 to 6%. And all of a sudden, if you can get a real yield of 3+%, that's a lot more attractive than it had been the previous decade. So I think people were buying some of those credit markets for the yield, not for where spreads were. And that may continue into 26, but on the asset-backed side, I think things have been a little different where, again, housing is unaffordable, mortgage rates are high, and some of these markets don't have the same types of dedicated flows like you do in an IG corporate. And so I think that those things are good for securitized credit investors, but also it's one of these things that I expect spreads to continue to grind into that space in 2026.
Andrew, always a pleasure. Andrew Szczurowski, Strategic Income Portfolio Manager at Morgan Stanley Investment Management, kicking us off to the close here on this Wednesday afternoon with a focus up ahead on the healthcare sector and biotech, a conversation with John Flavin, the CEO of Portal Innovations, his diagnosis on the sector heading into 2026.
Plus, we'll get a pulse check from one of the world's largest pharmacies with Sree Chaguturu. He is Executive Vice President and President of Healthcare Delivery at CVS Health in an exclusive sit-down.
And we're going to unpack what's going on in the broader asset management sector. A sit-down with Dina Dilorenzo, President of Guggenheim Investments. Stick with us. A lot more coming up here on The Close. This is Bloomberg.
U.S. pharma and biotech share sales raking in their biggest haul since the first quarter 2021. And there's another big catalyst coming up in January. That is J.P. Morgan's annual healthcare conference in San Francisco, or as our next guest calls it, the Super Bowl of biotech financing. Joining us live is John Flavin. He is founder and CEO of Portal Innovations. John, great to speak with you. I will be at the J.P. Morgan Healthcare Conference. I'm particularly excited because you see a lot of deals get announced there. And as we look into 2026, what does that environment look like on the deal side and on the IPO side?
Well, thanks, Katie. The first half of the year and really the quarters preceding that were quite difficult for biotech. The second half of the year has been a whole different story. It's been quite dramatic when you look at the XBI, the major biotech public market index. It's up 30% for the year, which has outpaced the S&P and even the tech index. So pretty impressive recovery. A lot of what that is driven by, to some degree, has been a better outlook with regards to FDA. They're on pace to approve the same number of molecules or similar to what we've seen in previous years. That was kind of a black box heading into the opening of the year. Inflation has come down. Interest rates have come down in tandem as well. And that creates a better risk-on environment to make investments. What we're seeing on the M&A side is probably the most explosive part of the sector. Over $100 billion in M&A have happened this year. And what that means is investors that invested in those acquisitions now can recycle that money into new offerings. And we saw in November be the highest versus the peak at COVID, with $6 billion in volume associated with follow-on offerings. So that means money's going into new opportunities and new innovation.
Well, when it comes to M&A, the deals that you're seeing, where's there the most excitement? Because probably what the average listener is most acquainted with is what's going on with obesity, of course, GLP-1s and the weight loss wars. But where else is there excitement right now?
Well, I think anything that has to do with longevity, there's a recognition that, we have an aging population worldwide, but particularly in the area that we're watching very closely of neurodegenerative diseases like Parkinson's or Alzheimer's. Really key M&A activity that has happened this year. In fact, opening up the year, you had the J&J acquisition of Intercell, and with that, $15 billion acquisition. That kind of opened up the floodgates toward other neuro companies that increasingly the science is working toward identifying new ways to treat these previously untreatable diseases. Still in the early days there, but I think a lot of value to be created in the next decade, especially when you think about the use of AI and computing and even quantum as it applies to diseases of the brain.
I am curious, John, with some of the companies that Portal has been shepherding, I am curious about what the longer-term path is for those companies potentially to become public, and the idea of whether they need to go public in order to get the additional funding they would need to get whatever drugs or treatments that they're working on across the line.
That's the typical path. There are new alternative, sources of funding to these companies that they can remain private longer, but the capital needs for a biotechnology company developing a drug are in the hundreds of millions of dollars. And so the continuum often starts with a Series A, a B, a crossover, and then into an IPO. That typically, would be a cumulative amount of probably $500 million that goes into what will be required on the back end, which will be clinical studies, which are very expensive and lengthy in nature. On the other hand, in various very hot market sectors where there's unmet need, again, in the neurospace, for example, acquisitions can happen earlier, and sometimes that can happen even before an IPO occurs. And when you look at what's driving a lot of this, it's the pharmaceutical company patent cliff, $300 billion coming off patent in the next 5 years. And most of it can't come from their internal R&D engines, so they have to go out and acquire companies, and they're looking for really transformative science that are going after important market areas that previously were not really being able to be addressed due to science.
On the regulatory side, how comfortable are you so far with some of the initiatives that the current administration in the U.S. has taken, and your outlook for any other potential changes coming down the pike over the next couple of years?
Well, again, listen, there's no secret that there's been, dysfunction, within the ranks of FDA. However, that has not really affected what we're seeing from the standpoint of clear approvals, the movement by the FDA, Dr. McCary expressing several times a desire to accelerate drug approvals, the new voucher program to prioritize very important drugs in key unmet needs are important to shepherd these much-needed drugs through the pipeline. So those are all positive. I think one of the things that we're really excited about on the early stage side of things is watching, the acceleration of focus around approving rare disease drugs, especially using technologies like CRISPR. We have a company, Syntax Bio, that's applying it to, for example, making pancreatic beta cells. They just were awarded a collaboration with the Juvenile Delinquent Research Foundation.
All right, John, I have to leave it there. And we spoke with McCary, the commissioner, a little bit earlier this week here, talked about some of the acceleration on that, as well as the potential use of more real-world data in the evaluations. John, we'll catch up with you in about 3 weeks out there in San Francisco. Always appreciate it. John Flavin, the founder and CEO of Portal Innovations. When we come back, a big question about Micron. Will it meet the moment? Almost tripling in the share price this year. High expectations heading into its earnings print after the bell. A breakdown of what to expect when we come back after the break. This is Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. Let's start off with Urban Outfitters. Dana Telsey upgrading to outperform and bumping the price target to a street high matching $98. Higher traffic, higher transactions, as well as growth from the Nuuly and Free People movement brands cited among the reasons. Those shares up about 0.2%. At one point, they did actually trade above their all-time high. Next up, Sweetgreen. Wells Fargo cutting to equal weight. The analyst says the salad takeout chain continues to face fast casual headwinds that may force price cuts that will then in turn eat into margins. Those shares only fractionally lower on the day, but we should point out they're down 84% since their last all-time high about 12 months ago. And finally, Constellation Brands, the maker of Modelo Beer, Mondavi Wine, Jeffries, which upgraded the stock to buy in July, walking that back now with a cut to hold. The analyst cites the U.S. immigration crackdown and its continuing ripple effects on Constellation's beer business, which they say at least half of sales are typically to Hispanic consumers. Those shares down for a fourth straight day as they head towards their worst annual loss in 11 years. Those are some of our top calls. We now want to push ahead to what comes after the bell tonight. All eyes right now on Micron, which despite a pullback today, those shares have almost tripled year to date in what's looking to be the best year for the stock ever. But of course, with those high valuations comes high expectations. Matt Bryson, he joins us right now, Managing Director of Equity Research at Wedbush Securities, to talk about what he expects. Matt, what are you expecting?
I think they're going to come in ahead of their guide, at least the high end. Looking forward, I think that's the real question, Roman. I think pricing has been better than is in my model than is in street models. I just don't know how aggressive management's going to be when they guide.
Yeah, and this gets to this idea, though, Matt, as to like how much more upside can you really get out of a stock that has performed as well as it has so far? I mean, what is that catalyst, if at all?
It's really just pricing going up. So pricing has moved amazing amounts over the last 3 months, and that drives margin gains. All I've seen is both NAND and DRAM have been getting tighter. Tighter conditions tend to drive higher pricing, and so then it comes down to the question of what is the peak. 2018, the peak was 60-ish% gross margins. If you throw that in the model now, you get them doing about $30.
Well, pricing trends have definitely been the friend of Micron, but do you expect that to continue at the levels that we've gotten used to? I'm taking a look at the expectation from Bloomberg Intelligence, and over there, I mean, when it comes to pricing growth, they expect that to moderate in the first half. How much of that is a risk in your forecast?
So I think that lots of people tend to think about the second derivative. So they own memory stocks until the shift in pricing changes versus the pricing going up or going down. I think that's a bit of a risk moving forward. At the same time, when I look at my estimates, at analyst estimates, the numbers that I have baked in for the next few quarters are well below what I believe pricing conditions actually did. So I think there's still a fair amount of room for upside for pricing and margins when they guide or when they deliver their February quarter.
That's interesting. So it sounds like you're building in the idea that management will probably be conservative in their own guidance.
I definitely am, right? You don't want to get ahead of management, and then with this management team, it seems like they tend to be a bit conservative, except when they aren't, and so it makes it a little bit tricky from an analyst perspective to try to get numbers right.
I am curious about, Matt, in the past, before the big AI boom, we always kind of looked at Micron as being one of those sort of classic, sort of cyclical type of names here. Is that still the case?
That is definitely the case. The only difference for Maine is that typically there's unused fab capacity. And so they take that brick and mortar, they put equipment in, and they can bring on production relatively quickly. And that's what leads to a down cycle. In this case, because things were so difficult in 2022, 2023, 2024, everyone took CapEx way down, and they don't have those empty fabs ready for equipment. And so if you get AI demand growing at the rate it's been growing and continue to drive upside for memory demand, they just don't have any ability to bring on supply.
All right, Matt, great to get a preview with you. That is Matt Bryson. He is Managing Director of Equity Research over at Wedbush Securities. We'll get those numbers from Micron after the bell. And of course, this is a stock that has been outperforming year to date. You have to wonder if it might fall victim of its own success.
Yeah, and a lot of this run-up has been recent. I mean, if you look at the top of the leaderboard in the S&P, it's not the chip makers anymore. It's a lot of the memory chip makers now, rather than like the NVIDIAs and Broadcoms of the world. But high expectations, of course, comes with those high valuations.
Absolutely. Again, we'll get those numbers after the bell. But coming up, we sit down for an exclusive conversation with the Executive Vice President and President of Healthcare Delivery over at CVS Health. Next, we'll talk the health of the consumer and how the company is reimagining its strategy after its Investor Day. This is The Close.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these markets, also keeping an eye on shares of CVS. Shares are higher than 70% this year alone. That's as the company just raised its full year profit forecast and said that earnings would rise in 2026. Let's discuss further with Sree Chaguturu. He is the Executive Vice President and President of Healthcare Delivery over at CVS Health. His first interview since taking on the role. Sree, it's great to see you in person.
It's a pleasure to be here. Thank you so much for having me.
So you've been at the helm since November of 2024, just over a year. I want to talk about Oak Street because one of the big headlines from CVS's most recent earnings release was that you wrote down the value of your Oak Street primary care clinics for seniors by $5.7 billion. This was something that CVS purchased for $10.6 billion in 2023 before, of course, you were in your current role. Talk us through that decision and what is the path forward for Oak Street?
It's a great question. Thank you so much for asking. And if we just kind of step back and we look at what are we trying to achieve in America in healthcare, is we want to make sure that we can make sure that we have affordable healthcare, accessible healthcare with trusted providers. And our North Star at CVS Health is to be the most trusted healthcare brand in America. And historically, healthcare, the way we've paid for it is fee for service. So the more you do, the more you get paid. But what's really exciting about Oak Street Health is something called value-based care, where you're paid for outcomes. And those outcomes are, can you reduce healthcare costs and can you improve quality outcomes? And what we know with Oak Street Health is it's a premier asset in this space. So when patients are in Oak Street Health's care model, which is focused on Medicare Advantage, the elderly over the age of 65, and those who have the most complex chronic conditions, is that we can reduce admissions by 42% compared to patients in traditional Medicare practices. So incredibly exciting. But what happened over the last couple of years, back to your question, is that there's been a lot of macro changes. Post-pandemic, what we've seen is that there's been more utilization of healthcare than before. So patients are sicker. And then what we've also seen is that reimbursement, so the revenue that's coming to practices like Oak Street Health, and it's not specific to us, it's across the industry, has come down.
Right.
And there's a whole bunch of very technical issues on why that's happened. But essentially, healthcare costs are higher, reimbursements are lower.
Right.
And so when we looked at that, we saw that, according to our original deal thesis, then, compared to where we are today, that we ended up taking the impairment across healthcare delivery. But I'm incredibly excited about the path forward. Maybe we can spend a few moments talking about that.
Well, I have to ask you my next question. I think that you already answered it, but when it comes to how Oak Street is positioned in your portfolio, is that an asset that you would consider selling?
No, we are actually big fans of healthcare delivery and of Oak Street Health. As I just mentioned, we know that the fee-for-service system is broken and that value-based care is critically important for the future of healthcare. This is a premier asset in the space. And so we have taken an impairment. We have also made the thoughtful decision to close certain clinics that didn't have a path to profitability. But we have also invested in the path forward, and that is having negotiations with our payer colleagues to make sure that we get equitable and fair payments for the services that we render for the patients and members that we serve. And in addition, we're investing in our technology and investing in our medical care management. So we're excited about the future moving forward.
What is the integration of Oak Tree? I mean, because basically it's standalone, as a standalone brand to a certain extent. How is that, if at all, integrated into, or maybe potentially going to be integrated with the actual in-store CVS clinics?
So healthcare, what we have with Oak Street Health is a payer agnostic. So that means that we serve not only Aetna, which is the health insurance company underneath CVS Health, but a broad variety of health insurance companies. And in addition, so that's number one, we're payer agnostic. Number two, we are deeply integrated into the CVS Health ecosystem. One of the things that we announced is an open engagement platform, our consumer platform, our digital application. So our patients are able to access their resources on their application. And in addition, we are working with other parts of our company, such as Signify Health, to provide in-home health assessments for Oak Street Health members.
Well, one reason why I asked that is really just about how this is being marketed to the consumer. I mean, CVS is a pretty well-known brand. I mean, no offense to Oak Street, but, I think a lot of people, if you went on to the corner of 59th and Lex, wouldn't know what that is. So I am curious as to why not leverage the CVS brand name a little bit more in those endeavors with Oak Tree Signify.
We are 100% we are. So we're educating consumers in CVS Health locations about Oak Street and the opportunity to join an Oak Street practice if they are in their community. And that we have seen a great amount of traction with that strategy to leverage the two brands together as opposed to each alone. And in addition, we have with Aetna we offer awareness around Oak Street Health as a potential primary care practice, along with other primary care practices that you could have through Aetna. So we are looking and continue to execute on those synergies. Another place that we've seen a lot of great traction is for patients who are seen by Signify Health providers. So this is our in-home health assessment company. So we have done 3.5 million home visits with our network of 10,000 clinicians, and many of those patients don't have a primary care clinician. So we actually advertise and offer awareness around Oak Street Health as well as other providers so that they can get connected to care.
Well, really appreciate the context on where you're going with Oak Street, because I know there were a lot of questions about that after the earnings report. I do want to talk a little bit about vaccine trends that you're seeing. It's flu season. I'm sure you got a flu shot. Have you noticed any changes when it comes to vaccination patterns with the flu or with COVID shots in 2025?
So vaccinations continue to be a critically important tool in helping to prevent illnesses and protect American health. And what we've seen is that this has been a very dynamic environment in terms of vaccine uptake. What we've seen at CVS Health is that there continues to be a need and a desire for a trusted provider in the community. And again, our pharmacists continue to be a trusted resource in the community. We have seen that there has been a share shift away from physician offices as physician offices and hospital systems are rethinking, should we carry the stock? And especially when we have a trusted provider such as CVS Pharmacy in our community that is also on an integrated electronic medical record with our health system. So that allows us to provide those vaccines. So share shift away from hospitals and physician offices to CVS Pharmacy.
What kind of dialogue are you having, if at all, with the current White House administration, particularly given some of the changing stances on vaccines and the idea, quite frankly, of them just not even promoting them in the same way that we saw in previous years? What changes do you make?
Yeah, so we continue to be thoughtful partners to the administration in terms of being able to provide access and to do this according to state and federal regulations. These change on a constant basis, and we update immediately based on the regulations that are brought out, but we continue.
But you've seen conflicts in that right now, where you have the federal government basically saying to a certain extent, either don't do these things or these things may be dangerous. Meanwhile, at the state level, you have the state health department saying, go out there, get your flu shot, your COVID shot, etc.
And we just follow what we see as the regulations. And so this is, again, a highly dynamic environment. What we do know is that people are looking for trusted providers in their community. And we continue to be that as our 9,000 locations and our trusted pharmacists provide the information on what is appropriate for your specific health conditions, and as well the federal and state and local regulations of that community.
Well, to build on Romaine's point, I mean, at CVS, are you seeing any differences when you take a look at the patterns with COVID shots, which I think it's fair to say that the administration is de-emphasizing, versus, flu shots and other shots?
We continue to see that there's a great demand for vaccines in the community. Yes, there's been overall changing patterns of who is seeking for those vaccines, but what we continue to see is a tremendous demand for vaccines within trusted locations such as CVS Pharmacy.
So talk to us about just the evolution overall. And I know you're just running kind of one piece of the broader CVS story, but CVS is a much different company than what it looked like, 10 years ago in terms of, what its services and primarily where it's making its money. Is this the evolution? I mean, is at some point, this is basically but basically more of a healthcare company than what we tend to think of CVS, which is pharmacy first and, a place to pick up household goods.
100%.
Yeah.
We see ourselves as aspiring to be the most trusted health services company in the country. And, we want to build trust through access and engagement. We do that through our various companies. So Aetna through healthcare benefits, Caremark through pharmacy benefits manager, CVS Pharmacy, as well as healthcare delivery. So again, it's a broad portfolio of health services providing access and engagement, whether that's virtual or in your community.
All right. Well, really appreciate it, Sree. Very enlightening and interesting to see the progress. Obviously, you've made it in a year, but really what CVS has done over the last decade or so. Sree Chaguturu, Executive Vice President and President of Healthcare Delivery over at CVS Health. And of course, Katie, you kind of kicked us off talking about the share performance here. And this is something we've talked a lot about on this show for this year. The idea that AI has sort of sucked all of the attention out of the room, but you kind of forget there's kind of these stealth stocks that have had phenomenal years. In some cases, some of the best years that they've had in a while.
That's the thing. There's stories to follow in the equity market other than AI, and within the healthcare space, there's stories to follow other than GLP-1s. CVS is a great example of that. As I mentioned, shares higher by more than 70% year to date. I do have to note that follows 3 years of double-digit declines.
All right, we'll be back in a moment. Stick with us. This is Bloomberg. All right, time now for our stock of the hour, and it's a new stock, Andersen Group. You might remember it's the U.S. arm of the professional services firm that succeeded the shuttered accounting giant Arthur Andersen. An IPO yesterday, $16 a share, opened at 21 today, and at one point on this session, hit a high of 22.51. A return to glory, if you will, or at least to public markets. And joining us now to talk a little bit more about this is the CEO, Mark Vorsatz. He joins us from the floor of the New York Stock Exchange. Mark, thanks for being here. Congratulations on getting this back to market here. Talk a little bit here about why it was important for you to go to the public markets?
So we see consolidation of the professional service industry, which we think has really started about 5 years ago, particularly with the influx of private equity. And as part of our strategy, we knew we needed access to capital. We concluded as a group of partners that the best avenue for us to achieve our potential as a group of professionals was to do an IPO.
Well, let's talk a little bit more about that decision. You concluded that the IPO was the way to go in terms of accessing that capital. Why not private equity or the private markets? Because, you know, a lot of companies have made that decision and opted to stay private.
Sure. There's been a tremendous amount of capital infused from private equity into the professions. This is kind of an increasing trend. So just in the last 5 years, just in U.S. accounting firms, there's been over $50 billion of private equity. We wanted to maintain.
I think we're having some issues with Mark's connection there. It's been a little bit of a dodgy connection on the day here. Technology doesn't always work, Katie Greifeld here, but nevertheless, you got the gist of it here. Andersen Group, of course, kind of the remnants of the old Arthur Andersen, now coming back to the public markets, raising, valuation of about $1.7 billion there. And more importantly, really, just this idea, as he was talking about, this was the path for them to get those partners and back out into the market.
Yeah, really interesting. Of course, we keep talking about that private for longer narrative. Of course, Andersen being an example of a company that would prefer to get that funding in the public markets. But let's turn to one of the other big stories of the day, of the week, of probably the next year or so, and that is Warner Brothers Discovery. Paramount affirming its commitment to its $30 a share offer earlier after Warner urged investors to reject the bid. Joining us live is Bloomberg's Chris Palmeri. Chris, bring us up to speed. What is the latest lay of the land?
Well, you know, we've all been sort of waiting, how was Warner Brothers going to respond to this hostile offer from Paramount, and that response came this morning. It was pretty harshly worded. You know, there have been people were going to wonder whether Warner Brothers was going to maybe extend an olive branch and negotiate some more, but no, they basically said the Ellison family that controls Paramount's been misleading them about the financing, and they're sticking with Netflix.
I am curious, this whole saga, Chris, and I've had a hard time keeping up, but there was sort of a document out there called, that's referenced another bidder called Company A. That's not Netflix, and that's not Paramount. Who is that?
That is Comcast. You know, they were the big three bidders. And we did some back of the envelope math, and we figured out that Comcast was looking to value its NBCU businesses. We're talking about Universal theme parks, the movie film studios, NBC, at about $81 billion. Their plan was to merge those businesses with Warner Brothers and own about 51% of the combined company.
And I just want to go back to Paramount briefly, because my understanding was that the company said that that $30 a share offer for Warner Brothers wasn't its best and final offer, implying, of course, that they would come back to the table if they needed to. I guess that is no longer the case.
Well, the Paramount response to the Warner Brothers response today did leave open the idea of negotiations. So there was that element. I think it's widely believed that Paramount will make another offer. It's a little surprising they haven't done so already, like they didn't have one ready for today. But I think generally investors expect the bidding to go a little higher.
Give me a sense here, Chris, of kind of where Zaslav sits in all this, because it seems like, I mean, not seems, I mean, this all was obviously was sparked primarily by him and his own path to exit and I guess additional riches. Have we heard anything from him in this whole process?
No, the letter this morning came from the board. One of the juicier nuggets in the filing today from Warner Brothers was that Paramount had offered Zaslav the job of co-chairman and CEO along with David Zaslav. He's already looking to reap something on the order of $570 million from his various stock in Warner Brothers, and there was a suggestion that he could make hundreds of millions of more in a Paramount deal. By contrast, the filing noted that Netflix had not made him a similar management offer.
All right, Chris Palmeri, our man out there in Los Angeles, keeping track of the, well, seemingly never-ending saga right now, the fight over who gets the assets from Warner Brothers Discovery. As we count you down to the closing bells, Katie, we just got about 10 minutes to go here, and the sentiment here has certainly shifted to the downside, a bit of a shift from what we saw, really, quite frankly, just a few days ago when we were actually testing record highs.
Yeah, it feels like a long time ago, and you're not seeing any sort of bounce into the close right now. The S&P 500 now off by 1%. This will be the fourth consecutive down day in the row. As you can see, a lot of that pain is coming through in the tech sector. In your magnificent 7 names, the Nasdaq 100 down by 1.7%. And again, the bond market not acting as any sort of hedge here. Not acting as any sort of hedge. We should point out that volatility is ticking up ever so slightly. We talk about Bitcoin and how it just can't really get out of its own way. A read on some of that sentiment and risk appetite or lack thereof. And of course, you're taking a look right now in the commodity space, silver hitting another record high. So what does that all tell us as we move into 2026? Rebecca Patterson joins us right now to hopefully provide some answers. She's a former chief investment strategist over at Bridgewater Associates. Great to see you as always, Rebecca.
Good to be here.
I actually do want to start off on commodities.
Sure.
I mean, we've obviously seen what precious metals have done. I assume that's partly a risk haven type of move. But then yesterday's drop that we saw in oil with WTI dropping below $55 a barrel. Do you have any sense as to whether this is tied to macro concerns or something else, or is this just all just kind of its own idiosyncratic technical thing?
I mean, certainly day to day, you can have just a big flow going through that could be tied to one company. So I never like to read in too much day to day, but it is interesting to me today. The news about the naval blockade for oil tankers around Venezuela did seem to have some contagion in the market. We've seen gold higher, as you said, probably on a geopolitical hedge. We've seen oil companies' shares lower. Now, they're off their lows for the day, but they're down quite a bit despite oil prices being up. And so you're seeing them potentially seeing more volatility and more concern around their businesses. And then Latin American currencies and stock markets have taken a hit today. So there is contagion from this, and it's worth keeping an eye on that. With the oil market specifically, super great timing today. The Dallas Federal Reserve, I think, does an excellent survey once a quarter of all the U.S. Production companies, and it came out this afternoon. They're showing that the industry overall, despite all the deregulation focused on getting more oil supply in the U.S., very pessimistic tone among the big producers. Input costs a little bit better, a little lower than the last quarter, but still a problem. But what's interesting to me is that this group sees the oil price at the end of next year, WTI, at $62 a barrel. So around 56 today. So not lower prices, slightly higher prices, and that's maybe better for their businesses, but it's certainly not a big boost for their businesses. And then when we think about affordability, that problem in the United States, we're not seeing it translate into gasoline prices.
Well, that's what I'm curious about. We had the CEO of Phillips 66 on earlier this week, and we were kind of talking about this issue. Why not? I mean, I know it's not an automatic switch that when crude prices drop, that automatically we're going to see lower at the pump. But I mean, they've been kind of suppressed for a while now.
Yeah, I mean, Brent crude, WTI are both down about 20% year to date. If you look at the retail average gasoline price around the country, it's down about 5% year to date. You tend to see gasoline prices more flexible, let's say, on the upside than on the downside. So I'm not terribly surprised gasoline prices haven't come down more, but it just, to me, it's going to be interesting seeing President Trump's speech tonight. Is he talking about Venezuela and next steps there? That could bring more volatility to the oil market, either direction. And does he address affordability? And if so, if gasoline's not going to be the magic switch, what are the magic switches that he can pull, whether it's healthcare, whether it's food, whether it's housing, energy, electricity costs? There's not a lot you can do in the short run to fix that.
Yeah, there's a lot of questions about what the president will say when he addresses the nation at 9 p.m. tonight. I want to go back to the bond market, though, because obviously we're having a risk-off day. You mentioned that gold is catching a bid higher by about 0.9%. The bond market not really reacting. You can't read too much into a single day, as we discussed, but it feels like this has been a trend for a while now, that bonds have just been unreliable as a hedge.
Yeah, I mean, look, U.S. Treasuries, the 10-year Treasury, the yield is still down about 40 basis points year to date. So you have made money, a decent amount of money, owning longer-term U.S. Treasuries this year. That said, the reaction function is not what it has been in the past. And I think a lot of that has to do with worries about bond supply. The fact that we're running budget deficits around 6% of GDP, which is double what we've averaged over the last 30 years, we have to issue more debt to fund that. And that means more supply. Will we get enough demand? Now, the banks, through SLR reform, supplemental leverage reform, they might have more demand for treasuries. Stablecoin, it's more the front end of the yield curve, but that's another possible source of growing demand. The question mark is around foreign investors. Right. So far this year, they're still buying bonds. The question is going forward, if we are saying we're not going to be the same allies we've been in the past to Japan or to Europe, are they still going to have the same appetite to buy as much as we need them to buy to keep yields from rising? So I just wrote a paper with my colleague, Ishan Thakkar, today at Council on Foreign Relations. It literally just came out as I was coming here about the impact of trade on the Treasury market. And when you think about what drives Treasury bonds, it's going to be demand. We talked about that, supply, and then what the Fed does. And if inflation is a little stickier going forward than it has been, there's less the Fed can do. So there's a number of different cross currents here for the Treasury market. I think in 26, volatility, but probably not a lot of action. Beyond 26, when supply at the longer end ramps up, I think there's a risk that we have higher, not a crisis, but structurally slightly higher yields in the U.S. That matters for our economy. It's what we pay for mortgages, for auto loans, for companies to grow.
Well, let's talk about how that translates into the shape of the curve, because what you're saying at the long end, the supply demands and also the questions about actual demand and what's going on at the front end, questions too about what the Fed will do. But you add it all together, does that turn into a yield curve steepener?
Yes, and we've seen that this year very clearly. And I think that's probably going to be where we are for some time. Now, of course, if there is a major catalyst and we have a recession next year, that's not my view. It's no one's view, really. But if that were to happen, of course, you would still see all of that money in 60-40 portfolios, managed portfolios. There'd still be money going into bonds. The question that you just posed earlier is it the same reaction function we had for the last 20, 30 years? And I don't think it is. It doesn't mean they don't work, but maybe they're not as effective as they've been in the past. I think that's a big reason people are looking for other diversifiers, whether that is illiquid strategies that have low correlations with stocks or things like gold.
All right. I wish we can actually dive a little bit deeper into that, because I feel like some of those correlations are maybe a little tighter than some people are giving it credit for. Rebecca, always a pleasure.
Thanks for having me.
Rebecca Patterson, former chief investment strategist over at Bridgewater Associates, also on the Council of Foreign Relations. A new paper just out here. Katie Greifeld, as we keep an eye on stocks here, right across the screen. In fact, heading now back towards session lows.
Yeah, absolutely. Down by more than 1% on the S&P 500. Really, this line has been falling since we've been on air, and the close coming up, and it looks ugly.
Yeah, absolutely. Here we are keeping an eye on the fundamentals, but also a day where the technicals are really driving things. A potential close below that 50-day moving average. Will it happen? We'll stick around. Our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with the global simulcast. We're joined now by Carol Massar and Tim Stenovic from the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A decidedly down day. Stocks at session lows right now as we get just less than 2 minutes to those bells. And Carol Massar, we're going to close below some key moving averages unless something turns around in the next minute and a half.
I heard you talking about the 50-day on the S&P 500 and the significance of that. And so, yeah, you wonder if you're a technician, you're thinking, okay, if we break these levels, does that mean we go another leg down? Or do, buyers come in because it hit a certain downward point? So we'll have to see, but you're definitely seeing that selling into the close, and it does feel a little bit negative here.
Yeah, I mean, it's also just interesting to look at the biggest movers in the S&P 500 on a percentage basis today. I mean, at the bottom of the pack, you have those companies that have benefited so much from the rise in energy demand and the rise in data center demand, taking a real hit today. So it's not just the mega cap tech stocks, but it's also the sort of tertiary ones that are connected to the AI trade too.
Though old school energy stocks certainly higher today. I'm sure we'll talk about what's going on with oil. We've been talking about it on the close, how you think about the risk off day that we're having. Okay, gold is getting a bid, but the bond market not really acting as the haven that you might expect it to. So a lot of pain certainly being felt today across asset classes.
And I just want to point out, too, we are waiting later tonight, of course, that speech by President Trump at 9 p.m. Washington time. He's currently speaking to reporters right now. And his words, the message this evening is our country will be strong. Of course, the implications for what he says may not have an immediate market reaction, but certainly when it comes to policy and the potential economic fundamentals, it certainly could. Right across the screen here on this Wednesday afternoon, the Dow Jones Industrial Average down more than 200 points or 0.5%. The S&P down 79 points or 1.2%. The NASDAQ Composite down about 400 points or 1.8%. The NASDAQ 100 down 1.9, just barely touching that 100-day moving average. The S&P closing firmly below that 50-day moving average, and the Russell 2000, that was also lower, 22 points or about 1.1%.
All right, so that's your major averages. You know, we've been talking about this all day. Maybe you guys have too, but the S&P 500, you go in though, and you see almost an even split between winners and losers. 257 names in the S&P 500 gaining ground today, Katie. 244 to the downside, 2 unchanged.
It's slightly uglier if you take a look at the circle, which shows us what the sectors did today. Certainly, that doesn't look too great. In terms of what did outperform today, as I mentioned, energy as a sector higher by about 2.2%. We did see a rebound in oil. We are watching the geopolitical environment. Tech having a terrible day, off by about 2% as a sector.
Well, speaking of tech, a lot of focus on the AI trade, and one of the biggest memory chip makers out there, Micron, reporting earnings right now. The shares, the knee-jerk reaction to the upside here, as the company said EPS came in at $4.78. That's a big beat. The street was looking on average for $3.95. Revenue in the quarter on an adjusted basis, $13.64 billion. The street was looking for roughly about $13 billion even. So a beat on that. Operating income, a beat as well. Cash flow from operations, a massive beat, $8.4 billion. The street was looking for $6 billion. And the guidance going forward, the company says that for the current fiscal quarter, the second quarter, adjusted revenue, $18.3 to $19.1 billion. The street was looking for $14 billion.
All right, so this is an important one. I mean, this stock's up 169% year to date. It's down about 14% from an all-time high back on December 10th. But this is an important indicator. This is a dynamic random access memory company, but it's also going to give us some indications into also the AI trade that we've all been seeing under pressure as of late. So maybe some confirmation. Keep in mind, this plays into a lot of different markets, but it also plays into the market for AI servers. So to see that upbeat, we want to know the breakdown in terms of its markets to get an idea of what it says, again, on the AI trade.
I just want to put out, too, some more headlines coming out, Carol. The adjusted EPS figure that they're giving, the guidance for the current quarter, basically $8.62 at the top end. The street was looking for $4.71. So you're talking about basically estimates coming in at almost double what the street was looking for. It's also saying that its gross margin is going to expand to 67 to 69%. That gross margin right now tracking less than 60, but right now in the mid 50s.
Yeah, what a world. I mean, margins in the high 60% range. Hey, Sanjay Mehrotra, the chairman, president, and CEO of Micron Technology, out in a statement where we're getting a little more color on how the company is thinking and positioning itself right now. He said that Micron's technology leadership, differentiated product portfolio, and strong operational execution position Micron as an essential AI enabler. He said, quote, "We are investing to support our customers' growing need for memory and storage."
I do want to go back to those forecasts. That is the red headline across the terminal right now. Second quarter adjusted revenue coming in at $18.3 billion to $19.1 billion. That's the guidance there. The estimate had been for $14.38 billion. As Romain said, adjusted EPS, that second quarter estimate, also much higher than expectations. We were actually having a conversation with Matt Bryson over at Wedbush, and he said that, built into some of his forecasts was the expectation that management was going to be a little bit conservative with their guide, but taking a look at some of these numbers, so exceeding these forecasts, not seeing that conservativeness come through necessarily.
Yeah, and just like the headline on the press release, AI demand acceleration, along with other things, but they talk about it, driving record fiscal first quarter results, including highest ever free cash flow. Again, shares of Micron bouncing around, but mostly higher. The stock right now up about 4.5% here in the aftermarket. What?
And we were talking, you mentioned the fact that this is a stock that basically has almost tripled on a year-to-date basis, could potentially triple. But I was looking at some of the biggest winners on a year-to-date basis in the S&P 500. If you had ran this chart, the function on your terminal a few months ago, all the names would have been the bigger chip makers, the NVIDIAs, the Broadcoms of the world. At the top of that list now, it's a SanDisk, it's a Western Digital, it's a Seagate, it's a Micron. Basically, 4 of the top 5 names in the S&P 500 on a year-to-date basis are memory makers, Carol Masser.
Which is fascinating, right?
Yeah, well, all that data has got to be memorized somewhere, right?
Yeah, exactly. All right. Nice.
You don't want it to forget it.
Yeah, no, exactly. I want ChatGPT to remember everything about
Can someone
me.
install one of those Micron chips in my brain?
It's
That's
coming.
I forget a lot.
Don't
All
worry.
right, we're going to watch for some more headlines on Micron. Right now, it's up more than 6% here in the aftermarket. Let me go to some of the gainers in today's session. Got to talk about an IPO today. It's been a pretty good year for IPOs in 2025. Medline, maker and distributor of medical supplies, gloves, gowns, exam tables, all those things we love that are used by hospitals and doctors, making its public debut today, oversubscribed, raising $6.25 billion, year's biggest initial public offering. You can see that stock finishing the day up 41%. So many would say interest certainly among investors and maybe priced really well.
We have one of their gowns at home, by the way.
Do you like to wear those gowns at home?
Well, yeah, I was very comfortable, and we asked the hospital, could we take it? And they were like, sure.
They are kind of comfy, aren't they?
They are.
All right, good to know about.
Not very stylish, but comfy.
I'm trying to get my head around you wearing them at home.
I think they make the classic swaddle.
And I wear the little
blankets, too.
booty
Is that
socks,
right?
with the little skid things on, so I don't slip.
Oh,
Yeah.
who doesn't love those?
Yeah.
Right? You don't fall down the stairs. You don't slide on the floor. All right, let's go to another gainer, Texas Pacific Land Corp. TPL is the ticker. This one finishing the day up about 7.6%. Company announced a strategic agreement with Bolt Data and Energy. They're going to develop large-scale data center campuses across TPL's West Texas land holdings, with TPL investing $50 million in Bolt as part of the deal. So we saw some momentum there. And then Udemy, check this out, guys, up more than 33% at its highs today, intraday, finishing with about a 13% gain here at the close on a deal with peer Coursera to merge the two companies in an all-stock transaction. The combined entity with an implied equity value of about $2.5 billion. So Udemy, definitely an outperformer.
All
in
right.
today's session.
You got the outperformers.
Don't you like to say Udemy? Don't you like to say Udemy?
Udemy.
I like Udemy. Udemy. It's like my jersey comes out. Katie, your jersey comes out.
Exactly. You read me.
Let's talk about some of the decliners today. Stocks in the red include NVIDIA, down 3.8%. This was the biggest decliner on a points basis in the S&P 500, responsible for 19 points to the downside in the S&P 500 today. That tech rout hitting stocks amid skepticism about the AI trade. NVIDIA leading megacap stocks lower today. Broadcom also fell by 4.5%. Tesla down by 4.6%. NVIDIA down close to 17% from that October all-time high. So quite a decline in a short time. Shares of Oracle also taking a hit today. Speaking of the AI trade, down 5.4% on the day. This after it was confirmed that Blue Owl Capital is not contributing equity to a data center project in Michigan. That project progressing with Blackstone in talks to provide equity capital, and Bank of America leading a debt deal to help finance the project. Also watching the cost of protecting Oracle's debt against default. That was on track earlier to reach its highest closing level going back to 2009. And finally, GE Vernova shares taking a hit. Weakness in AI-related stocks, certainly on my radar today. GE Vernova down 10.5% today. The concern was that the weakness in AI-linked stocks spread to companies that are expected to benefit from electricity demand. So GE Vernova fell along with Caterpillar. Makers of data center products and power equipment also fell, and those companies too involved in building power and data center infrastructure also taking a hit today.
All right, take a look at yields. A mixed day there. Here, you had some comments earlier in the day by Christopher Waller that did move the market, but some of those moves really kind of reversed or at least settled down just a little bit. Slightly lower on the longer end of the curve and slightly higher, or on the shorter end of the curve, excuse me, and slightly higher on the long end of the curve. The net effect of it all is basically where we've been now for the last couple of sessions.
All right, guys, as as we wrap our cross-platform coverage, just want to mention Micron still up now about 7.3% here in the aftermarket. So we'll continue our coverage, I'm sure, on both sides. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there on the close on Bloomberg TV. Tim and I on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow.
When we come back, a closer look at the asset management industry, a closer look at Guggenheim Investments with the president, Dina Dilorenzo. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. A bit of a sell-off in the markets here on this Wednesday afternoon. The holding pattern we've been in. Saw a big break today coming off of the jobs report yesterday ahead of the inflation report tomorrow. But today it was really about AI and some questions about the valuations in the big cap tech space. The S&P down 1% on the day, closing below that 50-day moving average. The NASDAQ 100 down almost 2%, just a whisker away from testing that 100-day moving average. A complete loss of momentum that could compound, particularly given that we're heading into a holiday season, if you will, where volume will be light. Bitcoin reflective of risk appetite down 2% on the day. And of course, when it comes to risk appetite, the haven bids continue. Katie Greifeld, silver at another record high.
There you have it. Let's talk about what we saw on the equity landscape today. I wanted to highlight Exxon. Of course, that was one of your losers yesterday, one of your winners today. We saw that bounce back in oil. That's good news for Exxon. We know that big tech was really the big laggard in this market. You can see that in shares of NVIDIA, and you can see that in shares of Broadcom. Of course, Micron may be changing the stories a little bit after hours, which we'll get back to. But let's go to our top story this hour, and that is fixed income indexes seeing positive total returns across the board, as you can see, with Bloomberg's aggregate index up around 7%. Dina Dilorenzo of Guggenheim Investments highlights meaningful inflows into their fixed income platform, with the firm expecting 2026 to feature slower but stable growth, sticky inflation, and a Fed, Romain, that's closer to neutral.
Absolutely. Well, let's bring that person in right now. Dina Dilorenzo joins us, president of Guggenheim Investments and a managing partner at Guggenheim Partners. Great to see you.
Hi.
Performance has been pretty good. I mean, if you're a fixed income manager this year, it was decent. I guess the question is, what sort of continues that performance into next year?
Well, 2025 was definitely a strong year for us. We had significant inflows across public and private credit, particularly in total return and income-oriented strategies. In the fourth quarter, we impressively saw growth into strategies like asset-backed finance, which we can talk more about, our strategy for 2026 and some of the innovative products that we're launching as a result of client demand. But you're right, our performance was really great this year. I mean, we delivered solid performance over the benchmark relative to our peers, and I see that happening in 2026.
We'll talk about some of those new opportunities. You mentioned the asset-backed financing products. What are we talking about here?
So as we go into 2026, I think what most people probably should continue to accept the fact that the buzzwords of private credit are going to continue to grow. And I think it's actually a really good thing because it probably highlighted that there is probably a redefinition of fixed income, and the intersection of public and private credit is now becoming a core component in portfolios. And at Guggenheim Investments, we believe that combining the two is incredibly beneficial to investors. Okay. And we see that demand from our clients. With respect to the asset-backed finance offerings, they complement private credit really well. And we plan on embedding those into some of the private credit products to differentiate ourselves from all the others. I mean, I think we've all seen there's been a ton of merger and acquisition in asset management alone in 25, right? Whether it's a percentage ownership in one firm, or it's a JV here, or it's rebranding, selling off this piece. And the one thing I love about Guggenheim, and I've been there for almost 25 years, is we just stick to what we do, right? Yeah. We've been in the private credit business for over 20 years, where we do old school credit selection discipline, and that's really what's going to matter as we go into 2026. A lot of people have invested in private credit, and it's going to be about quality over quantity.
Do you know it's also my 25 year anniversary
Get out.
coming up in
Oh my gosh.
next month.
Oh, I'm so glad I brought
Not that you needed to know
yeah,
that.
but I brought you gifts today because, you know, you and I, you know, we always have to
That's
have this like
kinship, Katie
dialogue.
Greifeld.
I actually didn't know that, Romaine.
I brought-
It's like huge
I don't know whether to
news.
brag about that or be ashamed, but
No, you look great. I brought you some
Thank you.
Guggenheim swag today.
I started when I was 15.
Happy anniversary. I'm sure we're going to celebrate it once we get there. Let's talk a little bit more, though, about what you're seeing in asset-backed financing. What is sort of the pitch and the appeal there? I had on my chart behind me that you take a look at the best performing parts of the fixed income market year to date. Securitized products are one of the market leaders. And just talk to us about the interest, what investors see right there.
So the important part about ABF, which is what everybody calls it, and there's not a lot of managers that actually specialize in this, but Guggenheim is one of them, is, you know, when you look at direct lending, you know, the main thing that you have to look at when you evaluate the credit is the borrower's ability to pay the interest, right? When you look at the ABF area, you want to evaluate the hard asset, and the hard asset is what's going to pay back front end some of those payments. You're going to get the interest plus that front end payment, which is going to, you know, obviously boost the returns. It's going to potentially, you know, drive diversification and yield. So I think it's just another way to embed another version of private credit into these types of portfolios where I don't know if a lot of people really truly understand that there are very different types of private credit, right? There's subordinate credit, there's you know, the senior subordinate, opportunistic, distressed, and venture, right? Very different. So as we see all this M&A activity, it's not just going to be about buying private credit, it's who you are trusting to manage that private credit.
Absolutely. There's a lot of education that needs to happen, a lot of concepts that need to be socialized. I want to talk a little bit more about Guggenheim specifically, though. 2025, a big year for you guys. I know that you were certainly focused on building out your wealth channel. Talk us through, you know, what the goals are when it comes to 2026.
So the most important thing is, you know, technology and amplifying our expertise by utilizing the tools within data aggregation and leveraging the build out of AI, right? And I know that's a big buzzword, but we feel we're way ahead of the curve on that. As you know, we started aggregating and organizing and governing our data and the structured side of things well in like in 2020. So now we're already embedded in creating a very sophisticated set of use cases and tools to, you know, drive purpose in our investment process and non-investment process by utilizing a lot of the technology and the tools. And then that will allow us to scale a lot of the different products that we're going to be offering into the marketplace that will include all the same strategies that we've always outperformed in and we've been offering to our clients for, you know, the last 2 decades plus, but they'll just become more available in products for clients that are looking for different types of liquidity needs, like ETFs and BDCs, retail SMAs, interval funds. But that are highly customized, you know, for the different types of clients that are looking for those types of strategies.
When we talk about those types of clients, in terms of individual clients, are we just talking about the high net worth individuals, or have you guys also looked a lot more at the mass affluent?
Believe it or not, we see a lot of institutional clients wanting a lot of the same wrappers that once was utilized just by the wealth channel, right? Insurance companies, they're looking at ETFs. We've got insurance companies that actually want to, you know, seed BDCs, you know, embed those in their annuity offerings. We're seeing a lot of wealth management advisors, and as you know, I came from that world. You know, the average size of a wealth management advisory client now is growing. As a matter of fact, in the SMAs that we launched last year, that we thought were just going to be for the wealth channel, we're seeing a tremendous amount of interest from the middle market size institutions like pension funds, insurance companies. So, you know, I think there's really definitely beginning to be more of an intersection and a hybrid approach to all of these different type of offerings.
How do you think, though, about that mass affluent investors? That's something that Guggenheim, you know, prioritizes and focuses on, or is it more about those institutional clients?
No, it's definitely both. And as a matter of fact, I think you're going to see a growth in the mass affluent, right? And I think you're going to see a lot of demand coming from the mass affluent, and the way they want to access those products are going to be through digital, right? So online, you're particularly seeing that offshore. There's a lot of different tools that we're actually looking at so that we can be direct to consumer through technology. And I think that that's actually going to be the next phase over the next 3 to 5 years of where you're going to see growth for asset managers. Is you really have to get out of that comfort zone, and you have to start looking at other ways to drive results for the clients, but also give them access.
Unfortunately, we have to leave it there. Dina.
Oh, I want to come back.
We'll come back soon, please. That is Dina Dilorenzo. She is president of Guggenheim Investments. And coming up on the close, we're going to break down those results from Micron, of course, keeping a close eye on shares soaring in the after hours. This is The Close on Bloomberg. We're taking a look at shares of Micron, about 5% higher in the after hours following results from the chip maker. Joining us now is Jake Silverman of Bloomberg Intelligence. He covers semis. So, Jake, let's talk about the guidance, because second quarter revenue expected between $18.3 billion to $19.1 billion. The estimate had been for $14.4 billion. A similar beat when it comes to expectations for adjusted EPS. This was a company that a lot of analysts had expected to be conservative with their guidance. This does not look conservative.
No, absolutely not. No, it really does seem to, if you look at the gross margin guidance as well, which at midpoint was 68%, it really just implies such incredible pricing strength that they have right now. And it really comes down to supply and demand. And for the most part, there's just been a real supply limitation. All of that, for the most part, driven by AI. Also, there's been strong demand for PCs, smartphones, but the real story has been AI demand.
I am curious, though, how long this keeps going. I mean, I hate to look at gift horse in the mouth, but at some point, this isn't normal. It's going to revert to the mean in theory, right? Or maybe not. I mean, you tell me, is there that much sort of continued demand for these types of memory chips, particularly in the AI data center space going forward?
Yeah, so we're getting past historical precedent, to your point, really. I mean, in the past, we've seen up cycles tend to last somewhere around 10 quarters. The average is a little bit lower than that, actually, about 2 years. And so we're definitely extending beyond what we would typically see. And there's definitely question marks about the sustainability of that cycle. But high bandwidth memory is demand for that's very strong. It's constraining supply for traditional memory. And the guidance implies that the margins for traditional memory at this point might be higher than HBM. And so there's definitely a question about, what do they decide to do, the memory makers decide to do in terms of capacity at this point, and how does that impact the supply and demand balance?
Well, speaking about supply and demand, one of the big questions coming into this report was when we were going to see pricing trends start to moderate here. Does it follow, we're talking about constrained supply, that these price increases can continue at this pace?
I don't think that the pricing can increase at the same pace that we've been seeing, but it's also been incredibly strong. And so any sort of deceleration is probably, I think, somewhat realistic, and also not necessarily something that would be a detriment to the sentiment of the stock itself. But partially because if you keep increasing prices at this point, a lot of customers, like consumer products, PCs, smartphones, are just going to pretty much stop purchasing. There is an elasticity element to demand for memory.
All right, and just real quickly, this may be a dumb question. How often do you have to sort of buy these memory chips? I mean, is there like a lifespan where they have to refresh, or do these last longer than sort of the, like the NVIDIA type chips that they use for the main stuff?
Yeah, for high bandwidth memory specifically. Yeah, so these contracts tend to get negotiated around several quarters ahead of real procurement, and they tend to last about a year, and so then they get renegotiated over time. It can depend a little bit on the customer, the supplier, but I guess that's probably a good rule of thumb.
All right, great stuff. Jake Silverman over at Bloomberg Intelligence, a deeper analysis of those earnings that we got out of Micron as those shares move higher here in the after hours trade by about 5%. As we get closer to the end of the year, we look back, that late year pickup in capital markets activity. What does 2026 hold? Willkie, Farr, Gallagher partner Eddie Best is up next. This is The Close. M&A deal values, at least here in the U.S., in the third quarter, reaching its highest level in about 4 years, thanks to a surge in large cap activity, especially in tech. You combine that with IPOs picking up, and it could mean maybe a nice setup into 2026 for all of the folks out there making those deals, and of course the people who advise on them. Eddie Best joins us right now. He's a partner over at Willkie, Farr, and Gallagher to talk about his outlook for 2026. Before we get to 2026, 2025, the pent-up demand that we saw, particularly towards the end of the year in terms of IPO activity and M&A activity, did that surprise you?
Didn't surprise me. We were expecting it. Frankly, we've been expecting it for a while. We were expecting it at the beginning of the year. Obviously, there was a new administration that came in. People had a lot of high hopes for what that was going to bring. Obviously, there was a bunch of kerfuffle with tariffs, and that kind of muted the activity a bit. As people got more comfortable with it, I think the market in general has gotten more comfortable with volatility. Things started picking up again. IPO activity has been very, very robust in the last half of the year. Obviously, the SEC closing down, taking an extended vacation didn't help us. But as we were just talking about offline, we just priced the largest IPO of the year 2 weeks before the end of the year. So yeah, there was a lot of demand, and we think it's going to come in strong at the beginning of next year.
You're referring to Medline, which came to market yesterday, not an AI company, we should point out. But also, it was an interesting story because not only the biggest IPO of the year, not only not an AI company, but also it was the biggest private equity-led IPO, I believe, ever, which I would think, given all the strain that we've seen on private equity to find exits for some of their portfolio companies, that has to be an encouraging sign going into next year.
Absolutely. One of the things that we saw, certainly on the IPO side and even on the M&A side coming into the year, was all of the portfolio companies that the private equity firms were sitting on that they needed to monetize, either through sales or through IPOs. And the last half of the year started to see that. And certainly, now, interestingly, of course, Medline was only invested in about, I think it was 2021, so it hasn't been that long, and you've got a lot of other companies that have been sitting around longer. So again, I think that's going to be a good sign for the pent-up demand going into the year.
Those were like vintage years for a lot, that 2020, 21, 22. So the idea they even got it out says a lot.
We also had another IPO today, Andersen, notably not an AI company as well, but it was interesting, the reasoning from the CEO for why they chose to go public, basically that they didn't want to get too involved with private equity. And I wonder, how much they stand apart in that reasoning for going public.
Well, they certainly do. And if you think about the accounting industry in general has actually been taking a lot of private equity money. And so maybe they're positioning themselves as the anti what everybody else is doing. And so they're going to try to do it this way. But it certainly gives them a lot more freedom, a lot more independence to do what they want to do. They're not a CPA firm. They're really tax and consulting. They don't do the auditing that we see of other people. And so, yeah, it's very interesting. Some of the companies that are coming public now are not the tech companies, the AI companies, the high-flying companies. They're basic companies. We took a company public last week that is a construction infrastructure company, as old line as you can get. And, they came out roaring from the get-go.
I do want to talk about the biggest of the big tech companies that are still in the private markets. That's SpaceX, that's OpenAI. I think you knew that we were going to get that in.
Oh, yeah.
The possibility that these companies with trillion-dollar valuations could come public, I mean, what would be the potential impact on the IPO market, especially for the folks still in the pipeline watching how those are received?
So we who look at this saw what came out from SpaceX, that they're going to come out with $1.5 trillion valuation, and an IPO that could be $50 billion would be the largest one ever done. That's fabulous. If it gets done well, it trades well, it will help other people because that will be a bellwether for the market. On the other hand, it could also soak up an awful lot of the cash that's waiting to be deployed. One of the interesting things that we've been seeing is more and more of these companies are staying private longer because they can fund themselves in the private markets. You just had Databricks the other day announce a $4 billion capital raise at about $150 billion valuation. You've seen $40 billion private raises. So in some respects, a lot of these companies are saying, I don't need to be public yet. Someday I will because I'll need more liquidity, but I can raise the money to build my business, incentivize my employees, buy other businesses. So the private markets are actually robust enough to allow companies to stay private a little longer if they want to.
Yeah, and we had the CEO of Databricks on earlier this week who kind of hit that point as well. I do want to ask you specifically about M&A deals with regards to the regulatory environment. There's been a lot of discussion that some of the M&A activity we saw this year was a result of a little bit more of a hands-off approach of the current administration, at least relative to what we saw during the 4 years under Biden. Is the conversation now, when someone picks up the phone to decide whether they do this deal, is it about the regulatory environment, or is it more about whether it makes good financial sense?
It should always be about whether it makes good financial sense. That's the first start. Then the next question will be, hey, lawyers, am I going to run into problems? Certainly coming into the Trump administration, we were expecting there to be lighter regulation coming out of the DOJ and the FTC. At the beginning of the administration, we still did see some enforcement that I think surprised some people.
Yeah.
One of the things, though, that we've seen between the layoffs in the federal government and some other things is that they're really constrained in terms of just the time they have. And so they're looking at the bigger deals right now, if they're looking at them.
Yeah.
So what we've seen is a lot of the mid-market and lower market PE deals are getting through much quicker because they just don't have the time to look at everything. So that's one of the things that we are looking at. Now, on the other side, the SEC doesn't have enough capacity, but certainly if you're talking about M&A, that is helpful for middle market deals and some others.
Yeah, that is a fascinating point, that there's human capacity issues here as well. Looking forward into 2026, before we let you go, when it comes to M&A, which sectors do you think are most ripe for consolidation at this point?
So in terms of M&A activity, you still are going to see a lot in the AI infrastructure. So people like CoreWeave that, if you talk about, and frankly, that's all over the economy, whether it's real estate, whether it's anything else, people building these huge data centers. That's taking up a lot of capital. FinTech, financial services, we're seeing an awful lot of that as well. AI is very helpful for those. So you've got companies who are getting into that on the financial services side. Energy is still going to be big. And frankly, as we just talked about, we talked about 3 different companies that were not fancy, sexy kinds of companies that were going public. So you still have a lot of those companies, and you still have an awful lot of companies that are owned by PE firms that they need to liquidate. They need to somehow monetize. So I think we're going to see a very robust next year in terms of M&A activity.
Absolutely. Hope to keep that conversation going in the new year. That is Eddie Best. He is partner at Willkie, Farr, and Gallagher. Meanwhile, let's take a quick look at some of the notable movers in the after hours. We have to talk about Micron, of course. That what was expected to be conservative guidance was not that. You can see shares up 3.4% or so, down from after-hour session highs, but still green, Romaine.
Yeah, absolutely. And keep an eye on Insmed, not a stock that we talk a whole lot about, but it's a pretty big pharma company, biopharma company with a $42 billion market cap. The shares have been halted. This after a study on one of its nasal treatments failed to meet some of the key metrics that investors were looking for. Those shares down 18% in the after-hours trade.
All right, we'll continue to follow those. This is The Close on Bloomberg. Well, Bloomberg Intelligence estimates that the global pet industry will hit $500 billion by 2030, and Rover, which is one of the world's largest online marketplaces for pet care, is cashing in on that growth. The company putting an emphasis on international expansion, having just entered Australia and 5 other countries in 2025. Brent Turner, he is the CEO of Rover. He joins us now. Brent, it's great to have you with us. So clearly you're expanding here. We mentioned Australia, which is a market you just entered. When it comes to the global landscape, where do you see the biggest opportunities for growth right now?
Well, Katie, thanks for having me on. And for those listening that are not familiar with Rover, here's what you need to know. If you need a dog sitter or a cat sitter, dog walker, dog trainer, Rover is number one. We're number one in the United States and Canada, in Europe, and with the acquisition of Mad Paws that we announced recently in Australia as well. And I appreciate the question. We are happy with our existing footprint. I think we are, with this latest expansion, we are focused on in-country growth. There's always a chance that we will do additional countries in the future, but where we are today, with 100 million pet-owning households in the United States, and about 130 in Europe, and adding another 6 or 7 million in Australia, that's plenty of room for growth for us.
Yeah, absolutely. When you just think about how many people own pets, I do want to talk about, you're expanding in countries. As you said, you're happy with your footprint as it stands right now. I know that you've acquired 3 companies since 2024. Are you happy with that current portfolio, or, could you see yourself expanding and potentially being more acquisitive in 2026?
Well, I think we will be more acquisitive, I think. We were happy to acquire Cat in the Flat last year, Goo Dog this year, and again, Mad Paws. The reason we buy companies, at Rover is because we think we can add more value as a combined entity to addressing customer needs on both sides of the marketplace, both pet parents and care providers, than we can as standalone entities. And we've found something to like in each of the companies that we've purchased, and are excited about all of them. That doesn't mean that we're done. And I think one of the things that Blackstone ownership of the company has opened up for us as M&A as another lever for growing the business. It's always been interesting for us, but we've moved into another gear in this phase of ownership.
I love it. Cat in a Flat. I wasn't actually familiar with that. I'm not a cat person. Katie's the cat person. I'm the dog person. Cat in a Flat, Mad Paws. I love these names, by the way.
Very good.
Yeah. Can we talk about names for a second? The most popular pet names?
I'm ready.
Katie has a cat named what?
Catrick.
Catrick. I don't know what that stands for.
It's Patrick, but with a C because he's a cat.
Okay. And I have a dog, a Basenji, Yenzi, the Basenji. There she is. Look at that. Look at that. Beautiful, beautiful girl there. Milo and Luna. These are the top names in the UK. Charlie and Luna here in the US. Simba and Nayla in France. I could keep going on, Brent. But you tell me. There's Catrick right there.
He's gorgeous.
What's most popular with you?
Well, I am personally a cat person as well. I'm one of the few cat-only people on the executive team. I love dogs. We just don't have any right now. And we have 2 cats, Boxy and Mr. Wiggles. And Little Mister was actually we are also a regular foster family for kittens. And Little Mister was a foster cat that we just could not send back. Although I will say Boxy has chosen me. Cats choose people, one person in the household a lot of times, and she has chosen me every morning at about 9 o'clock. If I'm unwilling to pick her up, I get a good yelling at.
I am curious here, as you kind of expand this business, I mean, how far can it go? I mean, obviously dogs and cats are kind of the primary animals, pets that most of us have, and obviously the ones that probably require the most care. But does Rover become something even bigger than that?
Well, when even back in the days when we were raising venture capital, we used to, one of the first things we would say is, hey, pet care, what's the first brand you think of? And people would say, well, nobody. And we would say, that's right, isn't it? That is right. And we still see that opportunity out there. And every day it becomes, we become more synonymous with particularly what we would call the everyday services. And we think the key to continuing to grow is to continue to focus on customers on both sides of the marketplace. We'll roll additional services. We rolled training this year. We're really excited about its momentum. I think grooming is certainly fair game. Pet adoption is fair game. And so you'll continue to see us do those types of things. We would really like to become the essential app that really needs to be on the deck of every phone for every pet owner, the essential app for all your everyday pet needs.
Brent, I also want to talk about your relatively new ownership. You mentioned Blackstone, which of course acquired and then took Rover private in February 2024. The conversations we've been having all week are about the IPO market and sort of these private equity-backed IPOs finally coming public. When you think about the future of Rover, could you see a return to the public markets?
It's always a possibility. I do want to say about the private equity ownership. We were venture-backed for 10 years. We were public for 10 quarters, and we were wrapping up our second year being private with Blackstone. And I would say without reservation that the Blackstone experience has been the best in terms of the 3 ownership experiences we've had. And I'd measure that in terms of the amount of time and focus that the executive team is able to spend working on the business and addressing customer needs, as well as the ability to make catalytic investments to grow the business and strengthen it, the flexibility to do that, not only inside the business, but on the M&A front in a way that we almost certainly would not have done as a public company. And so the core thesis that they are operating under, we're certainly experiencing that in the office.
All right, Brent, really appreciate you taking time for us. Interesting phase of your career now here, leading Rover into the next chapter of its life. Brent Turner, the CEO of Rover. All right, coming up here, we're going to drill down into the energy transition with the firm right at the heart of that shift. The conversation up ahead with Tyler Reeder over at Energy Capital Partners. Stick with us. This is The Close on Bloomberg. All right, Energy Capital Partners, it's an investment company founded about 20 years ago, and it's focused on the energy transition. Having one of its best years on record, the company returning $5.5 billion to investors on the heels of its busiest years for exits, at least according to data compiled by Bloomberg. Joining us right now is Tyler Reeder. He's the managing partner and president at Energy Capital Partners. Great to have you here.
Great, thanks for having me.
It sounds like a good year. I mean, you've raised a lot of money over the years since your inception, $35 billion plus. You're paying out, what, $5.5 billion or so this year. That's pretty good, right?
Yeah, it's a great year for exits. I think we had a lot of investments that were really well positioned that we invested in over the last several years. Our interest is certainly attracting a lot of capital, a lot of interest, so we were lucky to have some good realizations this year on some high-quality companies. And at the same time, we found it a really good year also for making new investments, so it's been a really active time.
Well, let's talk about those new investments, particularly when it comes to the AI data center / tech space. I mean, we just got earnings out of Micron, and one of the headlines that I thought was interesting coming from the executives was, quite frankly, they said they were sorry that they couldn't meet customer demand. And we've heard this from a lot of companies in this space, that demand is far outstripping supply. And of course, a big component of that is going to be not just the building out of these data centers, but the power to supply them. How are you investing?
Yeah, look, I think that's right. I think the speed at which this all happens is largely going to be dictated by access to electricity. And so some of that can come from the grid, existing resources, and some of that's going to be new build resources. So we're playing that in a variety of ways. In just the past year and a half, we made 4 investments that we approach it in different ways. We bought some high-quality gas-fired power plants in Ohio and around that area that we think is a good area for data center activity. We bought a company that manufactures smaller turbines that could be used for backup power and intermittent power. And we're selling those turbines quite rapidly right now. We did a co-located data center in Texas, where we have a data center, a hyperscaler customer on our site. We're delivering power directly. And then we also took private a large renewable company. So we're finding this to be a great environment for electricity and finding lots of different ways to invest around that theme.
We'll ask you a question that I ask often when it comes to the build out of data centers. And I hear what you're saying, that there's a lot of interest for, power generation for these data centers. Do you have any concerns that, we could be in the midst of an overbuild? And, how does that factor into the decision tree that you're looking at when you're making these investments and making these partnerships?
Yeah, I think that's a great question, and I think it's much more tough to project very long-term demand. But when we look at near-term demand, we see it on the ground. We see it in the conversations that we're having with hyperscalers, in the deals that we're doing. We see it in the forecast, and we're seeing it show up real-time in demand. So we're seeing sort of real evidence of that. When we think about what we're trying to do here, is we're trying to find high-quality assets to power near-term opportunities. So I think for us, we worry less about trying to forecast exactly where demand will be in 10 years, but we see it right now on the ground. So we're looking at options to provide electricity for these data centers from our existing assets, and we're looking at opportunities to build new assets too, and all varieties of assets. It's going to take natural gas-fired facilities, it's going to take renewable assets of all sorts, and eventually it'll take another wave of nuclear as well.
Yeah, and it's going to be interesting to see that evolution. I do want to talk about just how active 2025 was for you. I'm looking at, the timeline here. December, October, September, January, you had several sales of some assets. You made some acquisitions as well. How does that set you up for 2026 in terms of, your expected activity on that side?
Yeah, I think we're going to be extremely busy. I look at the pipeline of things that we're looking at right now, and it is exceptionally busy with a lot of later stage opportunities. We're fortunate to have a lot of capital to invest, and I think we've been in these sectors for the past 20 years investing. So I think we're very well positioned with our experience and know-how in the sector and capital. So we're seeing just deal activity everywhere. I also think in the industry there's a lot of private equity firms that are looking to return capital. I think lack of return of capital has been a big theme, so we do think there'll be a lot of sellers as well. So we're excited to be busy and finding good investments next year.
And you think the regulatory environment is going to be supportive of that?
I do. I think that we're getting into a regulatory environment that recognizes the problem and realizes we're going to need to use the resources we have and build new resources. We're going to need permitting. It's a big challenge ahead of us. It's a big opportunity for the economy, and it's going to take a lot of electricity to power all this.
A lot of electricity to power all of this. I mean, just on that point, when you're thinking about, ways to capture that opportunity, are you thinking more on the debt side or the equity side?
For us, it's primarily on the equity side. So we are value-add infrastructure equity investors. So we're looking at providing equity for long-term projects, and that's our primary focus.
All right, Tyler, really illuminating. Hopefully we can talk to you in the new year once we start to see how things are starting to shake out.
Great. Thanks so much.
Tyler Reeder, Managing Partner and President over at Energy Capital Partners. As we push ahead now, Katie Greifeld, to what the markets will have their eyes on for the next 24 hours. Believe it or not, it's going to be a busy 24 hours. I thought we were like in holiday season. We're going to start off. We got a lot of earnings tomorrow, believe it or not. Nike, FedEx, among some of the more notable ones. Birkenstock
as well, CarMax, Accenture, Darden Restaurants. Certainly an interesting read across the economy there at the micro level. We also get the Bank of England out with a decision.
No.
Yes, 7 a.m. The ECB out with a decision.
Don't get me excited.
And then 8:30. Boy, what a doozy.
Yeah, let's bring it back to the U.S. here. Of course, we get the jobless claims numbers, but also that delayed November CPI report.
Yeah, absolutely. And before we get there, actually, we have an address coming from the president at 9 p.m. tonight. A lot of questions about what exactly we're going to hear from the president.
Yeah, it seems like the contours of the reporting that he's going to take a bit of a victory lap on what he's accomplished in his almost first full year in office, and more importantly, push ahead to how he's going to address a wide variety of issues heading into a midterm election year in 2026. Stick around, because Joe Matthew and the team at Balance of Power, they're going to have full coverage coming up at the top of the hour of what to expect tonight, right here on Bloomberg.